Welcome back to Closing Bell. Treasury yields jumping before closing off their highs following Fed Chair Jay Powell's news conference last hour. The central bank saying it will accelerate the reduction of its monthly bond purchases and sees up to 3 rate hikes next year. For what all of this means for the fixed income market, let's bring in Jeff Sherman, Deputy Chief Investment Officer at DoubleLine Capital. Jeff, it's good to see you. I'm not sure if you were listening to the prior conversation, but we talked a lot about housing and the impact that some of these moves in rates could have on the housing market and could also have on inflation. I'd love to get your response to that as we jump off here.
Well, I think the first thing about the housing market, and something that a lot of economists have been talking about, is the lack of the housing market showing up in CPI data thus far, and that's the shelter component of CPI is running in like mid 3% range today. And if you talk about housing, you know, we've seen all the indices come out 19 to 20% type of gains year over year. So we know that it's a slower moving series when you look inside of the inflation data or the shelter data that drives inflation. And so what that means is that some of these transitory effects we've been talking about in the supply chains, you know, hotel prices, airline prices, things that have caused these temporary spikes, when they recede, you're also going to get this kick from the other side from the shelter component. So I know a lot of people have been talking about goods stays elevated. The chairman himself said he's seeing more in service spending. And so we don't think that the inflation data goes away or the inflation goes back to this 2 to low 2% range that a lot of people are talking about. So although the Fed is talking about their hiking forecast, they haven't really changed their inflation outlook for 22. And so to us, that's a little disconcerting because we think inflation is going to run a little bit hotter than those numbers. In fact, you know, we're starting to think that potentially we're going to see a 4-handle inflation for the bulk of 2022.
Jeff, first of all, you said transitory, so you've got to put $1 in the swear jar, as Atlanta Fed President Raphael Bostic would say. But in all seriousness, now we're on watch for 3 rate hikes next year. The Fed is calling for inflation in the 5s this year, in the mid 2s next year. But what happens if inflation is lower on the opposite end of the argument that you're making? And what happens if growth starts to slow down in 2023? Is it 3 and done?
Yep. Okay, so let's dissect that. I'll take the latter first. So if you get a slower growth environment and also a slower inflation market, I think the bond market is close to fairly priced. When I say bonds, I'm talking about treasuries here. The treasury market looks grossly overvalued. That is, yields are way too low for the type of growth we've seen as well as the inflationary environment that we are in the middle of contemporaneously. By the way, Kayla, we also think that potentially next month, when you get the next inflation print, it'll end up being 7%. Because you have a number rolling off in the December of 2020 that rolls off. It was about a 24 basis point increase in inflation. So that rolls off. So if you get something in the 40 or 50 basis points, 0.5% of inflation next month, that means we'll end the year with a 7% rate. That said, you know, when you talk about thinking about the way that the growth could disappoint, obviously it's Omicron, obviously it's the Fed hiking. However, if you go to the pricing of the bond market, you look at what the interest rate probabilities look like, the market has since Jay Powell turned his tune on inflation, stopped using the T word, started using the swear jar, as you said. Once that happened, the bond market started to price in somewhere between 2 to 3 hikes next year. So the market is on top of this. It smells it out. It sees that the Fed is on the hiking path. It's thus far digested the taper. But I think the elephant in the room is how the markets really respond to the taper and this dependency we've had on Fed buying. The good news on the other side of that is that Treasury supply should be diminishing somewhat commensurate with the bond purchases from the Fed. We'll see what Congress delivers us on the fiscal front and if that continues throughout the rest of the year. But the supply-demand balance is pretty close, at least as expected, for the first quarter of next year. So what that all means is that what I heard from Jay Powell today is that, you know, he's saying that they're going to be flexible. He himself is concerned about inflation. He got concerned over the weekend after that ECI print, the Employment Cost Index. And what he's decided now is that they need to accelerate taper. They can take their foot off the gas a little bit, but they want to get to the hiking regime. And I think he's done a decent job of prepping the bond market. It's way better than where he was 3 years ago when he had that disastrous press conference about automatic pilot. You heard that in his comments today. He doesn't want anyone to think that there's some formula or model they're following. He's talking about trying to do things in real time, be contemporaneous, and react to the data out there. And I thought it was very interesting that he said ECI concerned him. And I know one of the reporters called him out on that, but he said it concerned him, but he's not seeing wages drive inflation. And I agree with that thus far, but there is the potential for that spiral to take hold.